But all right, on that note, let's get on board with our fundamental analyst for the show, Aishwarya Didich of Fident Asset Management. Aishwarya, so good to have you on the show. Good morning.
Good morning. Good mornings to all the viewers.
Aishwarya, what is the sense of your markets right now? Because we saw a fall yesterday, and today also we see an extension of the fall. When do you expect the markets to rebound, or are the concerns big enough to rattle markets ahead as well?
So obviously, we have seen lots happening in the market, both in India as well as global. Especially, we started with when China's authority came out with a very accommodative stance on monetary policy, and we saw a very sharp, uptick in those markets where the different indices went up almost between 20%, almost 30% in his if I may use that word, around 4, 5, 6 session. And at the same time, we saw the geopolitical risk in the Middle East increased manifold after this Iran attacking Israel in that thing, and the expectation of Israel retaliation on that front. On plus, the data which is coming from US, all of this is giving an indication that kind of a risk of scenario is building up in the market. And given India being an expensive market, it will always be on its toes to see this volatility to pan out. And on top of it, if you look at last 5 7 days, the two things which has primarily hit India, which has fueled the fear index in the last 1 or 2 weeks, is obviously one is the dollar index. If you see, the dollar index has strengthened, that the green currency has been considered strong given the geopolitical crisis which is brewing up in the last 2 week or so. And at the same time, the crude which was getting into this bearish territory, all of a sudden see a strong uptick to almost 70 cents, $70 Brent, compared to a low of 73, 74 in just 2, 3 session, is possibly giving a hint whether the Fed could possibly take a pause on inflationary trend. Obviously, we have this data coming on Friday on the unemployment rate and jobless claims and all of that, which will give us more inclination. But for Asia as an area, both the dollar index, crude, and the receipt of from India to China, given the way China has created this excitement about reviving their economy, is possibly not favoring Indian market. We saw yesterday what kind of outflow that FI have sold possibly have a bearing on the market. And I believe till the time we have clarity on how the geopolitical risk will pan out, we believe this volatility is here to stay.
Okay, all right. Volatility is here to stay. You talked about China's stimulus and the money moving out from the Indian markets as well. But at this point, should investors hold on to their bets and increase their cash positions?
Yeah. So if I look at two things specifically on China and compared to what Indian investors should do, definitely China is a very lucrative market given the valuations that they are trading at, even in spite of the run up. But what I understand is that China is still in the mess. For them to completely revive and go on a growth phase is going to be a daunting task. It's not going to be very easy. So obviously, this excitement is having a lot of this hot money of FIs moving there and try to chase those returns. We can't deny that. But India will continue to remain a strategic, investment opportunity for FIs, especially for the passive flows. So I'm in that camp who believes that India's story has a very long-term, I would say, strong edifice to support. And this flow, obviously, the last 4 months we have seen close to almost $13 billion of inflow by FI. After the outflows 4 months back, I believe this trend will continue when this sanity will, both of this geopolitical risk as well as this China excitement settles down. And India will continue to see inflows given the kind of growth we are sitting at, given the kind of macro stability we are sitting at, and obviously the political comfort compared to what we have in China. Obviously, we can't compare this market. China the whole market cap of China is close to $10 trillion, where India is a little shy of from $6 trillion, where the GDP of these two countries is almost 5 times the size. The one of the most important reasons is the way the political framework, where we have more ability to extrapolate and predict the future earning possibility, which is very limited in China. So I don't really see too much into it about China's valuation and money flowing there and will possibly continue, which I don't believe that will happen. Coming back to India, I don't see investors any need to panic. We have seen it in past also, where whether it was Russia, Ukraine, we have seen it when it happened with Gaza and Israel. There will always be an impact on market because we are at a very stiff valuations, and there is a little room for error. But if I really look at the way it will impact Indian economy is very, very limited. Obviously, crude has spiked up 5-7% in last two sessions, but it's still lower than 10% year on year, right? And on the top of that, the kind of cartelization which is not working within OPEC obviously has a huge supply. And China is not out of the woods. So that will also impact the growth part. So I think India is in a very sweet spot. We are entering this quarterly result very soon. We will possibly see good revival. Interest rate cut is around the corner. So I will advise Indian investors to stay put, to stay calm, and stay on their stories which have a very strong earning trajectory.
Okay, all right. Broking stocks, they were hit yesterday, given that, SEBI rolled out some new F&O guidelines as well. And, many experts also pointed out on the impact on the trading volumes as well. But the likes of BSC, Angel One, they did well in yesterday's trading session. So what is your expectation? Is the fall legitimate, or how much can these broking companies brush off their impact?
No, I believe this is a welcome move. The way the kind of volumes has spiked up by this retail investor segment who possibly are not equipped, I would say, both from technical perspective as well as the fundamental perspective. I think that was going to become a bigger systematic risk. And I think what SEBI has done is pretty nice attempts to bring down the risk from the whole perspective. And on top of it, obviously, if you look at those companies specifically, say PSC or Angel One and all of that, I believe the bigger impact will be on the discount brokers compared to players like this. Every company has a strategic move they will play out with this new regulatory diktat. So to speak specifically for BSE, I believe it is a blessing in disguise. The BSE thesis has been working on because of their market share gains over the last 2-3 quarters, and with this dictate of limiting the expiry or on weekly basis and also on giving them a dedicated day, I think it will become easier for BSE to gain market share, both on national basis and on actual basis. So I think this will play out well for BSE, but it will be little difficult for brokers who are doing all those, I would say discount brokers, because volumes definitely will take a hit. So as far we have seen, only that index derivative has been brought up in that ambit of regulations, and large part of the volumes in options and futures happens on index. So those volumes will definitely take a hit, but it will not hit this exchange, in a way the market is expecting. But obviously, it will have an impact on discount brokers for sure.
Okay, all right. Let's see here, how the impact is going to be more on the discount broker side. But we have some business updates which have trickled in for the second quarter as well. Brokerages, however, they have pointed out that Q2 won't be as surprising quarter. Yes, there will be some sequential rebound in growth terms from the first quarter. But do you see this disconnect between current values of the market and growth expectations of investors to disappoint sentiment going ahead as well?
No, so obviously we are starting this quarterly season this week only, and if you look at the what market is expecting is almost anywhere between 12 to 14% kind of an EPS growth for FY26. The number will be above 1100, close to 1125 kind of an EPS number for Nifty 526. But if you look at the last quarter which went by, we saw a very muted performance. So the H2 of this financial year will have to do the heavy lifting. Now, when we enter this quarter, I don't expect too much of miracle happening around. Now, we have seen so far for the likes of FMCG companies where like Dabur on a specific reason has I guided for a very muted set of numbers, whereas Medico has indicated obviously that things are not that bad. Similarly, if you have seen majority of these BFSI companies, like I think HDFC Bank also reported their pre-business update just before we start. So banking sector is also poised to report decent set of number. No fireworks is what we can. at least see. I think the surprising thing could come from possibly from IT as an sector, and possibly from discretionary part of consumer. But I don't expect too much to happen on this quarterly season result, because a lot of this we have seen majority of this company has been hit hard because of a very strong monsoons. So a lot of these activities has been postponed in the last 2 to 3 months. So cement could be one of those sector, constructions, real estate, those will get major impact from that perspective. And again, if you have seen on FMCG side, obviously the growth has been decent, but there would be some commodity-led inflationary benefit, because that has gone down. So it will be sector to sector thesis playing out. But I would say we have to closely watch, not expecting too much of happening out of this quarter. But if there is not any further downturn on EPS earning growth, and we don't see those financial 26 EPS coming down in a single digit number, we are good. I think we are good with that perspective. So let's see how it pans out over the next two to three quarters.
Okay, all right. But any sectors that you see could see some re-rating after the Q2 results as well?
I would closely watch out for sectors in IT, as I said. I believe that is one sector where I want to see whether the discretionary part is really picking up. We continue to see the estimation of IT sectors, growth is pretty healthy, where we're seeing a number going from almost 1% to 3% for large IT players. If that happens with the background of rate cut, I think IT can see some re-rating potentials. Again, I would closely watch out for chemical companies as a sector. I believe that is one sector which have another 2 to 3 quarters of pressure on companies' revenue. But if we see some green shoots happening across revenue growth or volumes, I believe that re-rating is pending in this particular set of companies, and that could be an area where could interest that many investors there. And third would be obviously would be the discretionary pie. We are already seeing QSR companies in the last 3 4 weeks have seen a decent ramp up happening. It's basically a quasi discretionary pie. Similarly, if I see in other sectors, obviously you see the way coal tickets were sold. So there's a very strong discretionary pie which should do well. So I would be watching closely into that segment. I believe if they perform well, that's re-rating is on the radar.
Okay, so IT FMCG names that needs to be watched out. But Aishwarya, you also mentioned that interest rate cut path by the RBI, could turn as a tailwind for the Indian markets as well. But now that the RBI MPC meet will be holding their meeting next week as well, what do you expect? Do you expect the central bank to embark on an interest rate cut path, or are they expected to delay it, maybe to the remainder of the year or next year as well?
So there are two things to it. Obviously, with the change in the situation in the last week, with the rise in the geopolitical risk, and especially the spike in crude, I believe RBI will try to go in a wait and watch mode, where they want to see how this actually pans out, and what will be the impact on the crude and obviously on inflationary trend in India. We are sitting on a very comforting inflationary trend so far. Then in that case, we were initially expecting that the RBI will possibly do couple of cuts. Even everyone, we believe that it will be a hollow cut, not compared to what Fed is doing. At most, we will see 75 bips cut for the whole interest rate cut cycle for India specific thing. So not really much from equity market perspective. But I think given this outcome in the recent last week because of the geopolitical thing, I think it will be advisable. I think RBI will go ahead and see whether we are okay if crude doesn't spike up, then possibly they will take a decision. So most likely in this upcoming, I think it's on 9th, they will try to be in the wait and watch mode and see how things will pan out on geopolitical side. And just one comment on crude. Obviously, crude is getting a lot of excitement, and that is what is hitting the market as we speak. But I believe crude doesn't have a lot of I would say strategic demand drivers to really put it and go into much higher level that we have seen in the past. So until and unless really China picks up in the next couple of quarters or so, we don't see crude really going up. So I think it's going to be tough call for RBI to for specifically for this month's for policy date. But possibly, I think they will defer it in the coming quarters to take the cut.
Okay, so you don't expect the crude to take off as much as maybe like another $10 per barrel as well. Okay, so but thank you, Aishwarya. Thank you for sharing your insights. Pleasure speaking to you, and hope we connect soon as well.
Thank you so much. Thanks for it.
Okay. So on that note, let's just take a quick check of the markets once again. It has seen a bit of a recovery from the previous minutes that we were talking about. Sensex is down about now like 160 points, while Nifty is flat in the red as well. Majority of the sectors. They were seeing a bit of a red in the negative territory as well, but Nifty IT metal indices, they are doing well. India Wix now down about 2%, holding above that 13 levels as well. Top Nifty 50 gainers continue to be SBI Life Insurance, ONGC, Tata Motors, Wipro, Maruti Suzuki, while top losers on the Nifty do include BPCL, Bajaj Finance, Cipla, NTPC and Hero MotoCorp as well. But on that note, we have come to an end of this edition of the Opening Bell. Don't forget to tune in to 3:30 p.m. for Closing Bell. Until then, stay tuned to moneycontrol.com for all the news updates and market insights.